What's up, guys? In this video I'm going to share with you what it means to buy the dip and how to do it effectively with regards to stocks. This can apply to pretty much any financial asset, any digital asset, but I'm going to apply it to stocks, and you can apply it to pretty much any digital asset. So any digital asset's going to have a price chart. Let's just quickly go into the trading platform is called Trading 212. It's a UK based platform, if you guys don't know about it. I'm going to go into the investment account and then go into search. I'm just going to pretty much go through a few stocks just to show you what I mean. So this is part of the technique I use to buy stocks. You can use it, like I said, on any digital asset. So what you want to do is, usually on any digital asset, shows you the price chart for the year, as well as different increments like the entire lifetime, 3 months, the quarterly amount, the quarterly price, the monthly price, weekly, daily. So what I do is I go to yearly. Doesn't really, I think it's better to go as far back as possible, but yearly I think it's the best, better than the max, because it's short enough term to. I think the max is just too long term, and it won't over its lifetime. It would have, most stocks would have either gained a lot or just not. They won't be there. If they've lost a large amount of their value, they're likely not likely to stay in the exchange anyway. So I think yearly is the longest term. The longest term you can look at that will show you. That will expose whether or not the company has lost value, and that's what you're looking for. You're looking for companies that have lost value, a substantial amount of value in a year. It's better if there's an economic crisis during the year. This sounds a bit bad, but it's better if there's some form of recession during the year, or some form of setback that will cause the entire market or a specific sector of the market to go back. So let's check Amazon. Everybody knows Amazon. The yearly increase or decrease, it's increased by 3.07%. So we don't want to go for Amazon. We want to go for companies that have lost a lot of money, lost a lot of value in a year. So let's look at meta platforms, formerly called Facebook. So this is really good. This is a really big. Also, one thing that we want to look for is really big companies that have a sustainable a strong financial foundation, and have a great track record of great business. So meta platforms, formerly Facebook, we all know about that, run and founded by Mark Zuckerberg. It's lost a quarter of its value in the last year. And if we go to max, we can see it's gained a lot, almost 1,000%. So and also the chart shows it's quite consistent in the gains. Not as consistent as a company like Microsoft, but it's still fairly consistent. So it's lost 25% of its value in a year, which means if we buy it now, it'll be a quarter of the price it was last year, which is awesome. The 25% discount, I think I'll take that any day. Market cap, of course, we need to go through all of the financial ratings like market cap, PE ratio, and stuff. So let's just quickly scan all the financials to see if it fits our criteria. If you haven't seen my previous videos, I talk a lot about this financial analysis, reading financial statements, what financial statements are, etc. And you'll be able to figure out. If you look at my videos, you'll be able to see how to read financial statements, what the different financial statements are, etc. So I'm just going to quickly scan this. So the market cap is good, very, very large. We like big companies because they're less likely to fail. PE ratio is under, if it's under 10, preferably if it's under 20, preferably under 10. That's amazing. 16.55 is really good. Revenue 170 billion. Let's compare it to the market cap. That's about 1/6. So yeah, it's pretty decent. But I would say profit margin is way more important than revenue. Revenue, you can earn a lot and not actually make much of a profit margin. We see that in the retail sector a lot. So let's look at the earnings per share, $13.77 compared to the market price. It's not the biggest amount, but it's okay. It's under 10%, so not the best, but we can live with it. Dividend yield doesn't show because companies at this size don't tend to pay dividends, which is good because just if companies are good enough and their growth rates are quite high, and they've consistently made good growth rates, then we could trust them to reinvest the profit back into the company. So let's look at we're gonna skip the financial summary. Let's look at the free financial statements. Start with the income statement. 33% profit margin in last year, which is very good. The exact figure was 39 billion. Full income statement. We're going to check the previous years to see if they've lost any money in terms of profit. So 2020, 10 billion, 2019. Let's quickly check that. It doesn't exactly show. Gross profit, net income, net income, net income, net income, net income, net income. You can kind of calculate the profit margin based on the net income divided by the revenue. So let's quickly check the revenue. Revenue 70 billion, so 7%. So it made seven. So profit margin was about 7%. So 7% there. 10 billion. Sorry about this. Yeah, so pretty good. Yeah, it's pretty good. So but loss. So the second financial statement is the balance sheet. Let's quickly check that. Let's go into total assets. Total assets is pretty good. I think I made a mistake. One second. It doesn't usually show this type of layout, so I'm gonna quickly go back just to quickly check what's going on. Debt to asset ratio. Oh, okay, that makes sense. So usually I just read the debt to asset ratio straight from here. So the debt to asset ratio is 24%, which is absolutely amazing. Facebook has decreased its debt over time actually because they are, out of all of the large scale companies, they are the best in terms of the debt to asset ratio. I've noticed that over the past 2 years, but they've actually decreased their debt even further, which is absolutely amazing. So I would say Facebook is one of the best companies to invest in. If you look at all the other large cap companies, especially the tech sector companies, they all have a lot of debt, and Mark Zuckerberg has definitely managed to see the importance in not having much debt. So 2020, let's just quickly check the debt to asset ratio there. 2020 is I think it's about the same because the assets are higher, but the assets are lower, as well as the debt. Same thing with 2019. So let's check lastly the cash flow statement. What we're looking for the cash flow statement is to see if the net change of cash is positive. So as of 2021, the financial year hasn't ended yet, so it's still in 2021 financial year. So the net change of cash is negative 1.09 billion, but don't feel bad. We still need to check the amalgamated information. So the amalgamated net change of cash over the past 3 years. So net change of cash for the previous year is negative 1.32, and 2019 is 9.15. That's what you tend to see. You tend to see 1 year that's really large, and then some of the years that are negative or really low. So overall in the past 3 years, including the current, it's gained about, so let's quickly check, so 1.32 plus 1.1, so that's about 2.32. So it's gained about just under 7 billion in cash. So the company's grown purely in cash in about with about 7 billion. So that's awesome. So overall, Meta Platforms is definitely, as of now, a very good investment, especially considering that the price has decreased by a quarter. I think that's amazing. So yeah, I would definitely recommend this. But let's look at some other companies. So Tesla, pretty recent company, hasn't been around as long as Meta Platforms. As you can see by the chart, it's gained most of its value in the last. It's pretty steady. It's been pretty sturdy over the most of its life, but it's gained most of its value in. Let me just quickly check the date. The last 2 years is pretty much the last 2.5 years has gained most of its value actually. So yeah, which is pretty awesome actually. It's gained about almost 6,000%. Almost 6,000% in the last 2.5 years, which is just amazing. Almost just under a $20 trillion market cap, 181 PE ratio. So that's very high full price earnings ratio. The revenue is 53 billion. 53 billion. Earnings per share 4.8, which is very, very tiny actually. The earnings per share is very, very low, one of the lowest I've ever seen. Dividend yield, of course, is large cap doesn't pay dividends. Beta double the market average, but having a beta of 2, considering a company of this size and a company of this credibility, isn't too worrying. So let's look at the income statement. Sorry, I forgot the most important thing. We need to check the yearly performance. So Tesla's increased its value by 63%. So technically, we shouldn't even be looking at this company. Let's look for another one. Alphabet, it's gained 30%. Netflix. Oh, I recently invested in Netflix, so that one's gonna be good. That's decreased by 31%. Even better than Meta platform. So let's look at the market cap quick just to see if it's good. 170 billion, awesome. 28.73p ratio. Revenue figure 29 billion. Let's just quickly check the market cap again. Cool. Dividend yield, doesn't pay dividends. Profit margin 17, which is good, over 10%. And you can see it's quite consistent over the past 3 years. So let's quickly check that test ratio. Debt, like I said, most large cap companies have a lot of debt. This one has over double the amount that Meta platforms has. So this one's going to be a bit more risky financially. So let's quickly check the cash flow statement for net change of cash. It's lost 2 billion this year. It gained 3.2 billion last year, and the previous year it gained 1.23. So overall, it's gained about 4.5 billion in the past 2 years, except this one, and it's lost about 2.18. So it's gained about 2 billion, which isn't as much given its size. Given its size, it's not as much as Meta platforms, but we can live with it. It's still definitely a large gain in cash. And yes, that is me showing you how to buy the dip properly. That's just one of the ways. There's different ways, but this is one of the ways I use. This is the main way I use. So hopefully you got some value, and I'll see you in the next one.